Thank you, Denny, and welcome back to the Retire Young radio show. I am your host, Joshua David, and we're always having a great time in studio talking about the financial markets, how the smart money is moving these markets. So, Al, I want to dive into this next topic that we talk about every week, and there's a lot of misconception on how the markets really work. People think it's the news. Well, the news will, potentially move some short-term action in the market.
Right.
It'll create some short-term moves. But the market is going to do what it was going to do anyway.
Right.
So let's talk more about supply and demand. How do the markets really function, and why are the big institutions moving these markets in their favor? And sometimes it's to hurt the public.
Well, this is an interesting point you made there, Josh. The news, the things that impact the market from the news are really short-lived. There may be a big move up, a big move down, but typically after a period of time, a short period of time, the market kind of goes back into its normal functioning. And I think here's a question to ask all of you that are listening. If you're going to be in the market, shouldn't your goal be to work towards a point where you take a small risk with a high probability of that trade or investment working for you with a high profit potential? And if your answer is yes, and I think it probably is, then the important thing to know is that happens, that those low risk, high probability, high profit trades, investments always happen at or near a turn in price, which means it's important to be able to identify where that is on a price chart, whether it is turning in price to go from down to up or from up to down. And really what happens is when the institutions initiate a trade, the price starts to move. The public then sees that, and as human beings, we kind of fall into what we call this herding impact. Mm-hmm. And we don't want to be the first person. In fact, most people don't know how to be the first person into something, so they wait until they see other people that have already done that, have already entered. So that herding impact really provides the profit once the institutions have created that initial move. So wouldn't it be important to actually be in that trade, be prepared to be in it before the price turns? So you let the other people, the public, the herds, let them provide a profit for you. And how you do that is to identify where there is an imbalance between the buyers and sellers. When there's a balance, when there's an equal number of buyers and sellers, price is really not going to change much. It may fluctuate, a little bit, but very, very minimal. But at some point in time, there's a huge move out, either after people have started, or after institutions have started to buy, or after they have started to sell. There's a huge move out of a price, either in an upward movement or in a downward movement. And that happens when that balance is changed, when there's an imbalance. It can only happen when somebody or some groups with multi-millions of dollars, maybe hundreds of millions of dollars, are participating in a particular market or particular asset. That's not you and me as individuals. We can't do that. We don't have enough money. Warren Buffett does, and institutions, firms like Goldman Sachs, JP Morgan, they do, the hedge fund managers do. So our core strategy, which is our basic foundational strategy, is designed to and developed to identify where their activity is going to take place before it happens. I mean, it sounds sort of like crystal ballish or very much like timing the market. It's not crystal ballish, but it is timing. And that timing is based on history. And history has shown us, again, that turn in price happens when that supply and demand is out of balance. And that's the key, is to be able to identify that on a price chart, which is what core strategy does.
That is very important, to understand that imbalance of buyers and sellers. I mean, think of it this way. Everybody knows how much an iPhone costs. Let's just say, and I have an iPhone in my hand. If we're doing this on TV, this is what you're seeing. I have an iPhone in my hand, and we all know it's $1,000, and I'm going to sell this iPhone for $500. Who's going to buy it? Probably everybody, knowing that they can go and sell it, online somewhere for $1,000, right? So there's a profit there. Well, okay, now I'm going to sell it. So there's going to be more buyers than my one seller, one iPhone, right? So let's go with I'm going to sell it for. I'm going to get greedy. I'm going to sell it for $1,100. Who's going to buy it? Nobody. Well, now guess what's happened? There's more supply, my one phone, than the demand, because there's nobody that wants to buy it. You want to identify that imbalance, and you have to have a core strategy to do that. That's designed to teach you to find where those institutions are moving these markets, whether it's stocks, options, futures, or Forex. So, Al, okay, so we all know now how the market really moves. It's supply and demand. More buyers and sellers, price will go up. More sellers than buyers, price will go down. Now, the smart money, they are always creating income with these financial markets. And we have a lot of listeners that want to understand, how do they do that? Well, these techniques and strategies that we're going to get into right here, the public or the institutions are using.
Mm-hmm.
These are also available to us, the public. So let's talk about first, before we get into techniques, let's talk about the different assets they're using. They're not just using stock market. Let's talk about how great the futures in the Forex market is.
Yeah, the ironic thing, and we have talked about this before, the ironic thing is that these big institutions that have the public as their clients, they're trading different things. What are they putting their clients into? For the most part, it's mutual funds or maybe some individual stocks. That's not what they're trading. Certainly, the big firms trade stocks. They're not trading mutual funds, but they're using assets like the futures market, the foreign exchange market, the options market. And those are things that most people, when they hear those, they kind of back off, and there's some fear there. Well, the fear is just because they don't know what they are. They don't know how these assets work. What the things that are kind of specific to each one.
And here's the thing: they're not new. They're just different.
They're not new. They've
been
different,
around for a
and
long time.
Yeah, and they're available to us as individual traders. And the great thing is that the education is available to learn how to use them. Why do the institutions use them? Why might you want to use them? Well, for one thing, they have great leverage. And by leverage, I mean just a multiple of the dollars that you have. Every investment is multiplied by maybe 10 to 1 or 50 to 1 or 100 to 1. It's very much like a mortgage on your house. When you buy a house, for most of us, we don't put down the full amount. Let's say you're going to buy a $400,000 house. Most of us are not paying $400,000 in cash. Most of us have a mortgage where we put down maybe $40,000. Well, now you own and control a $400,000 asset for $40,000. It's like a down payment. You can do the same thing with these leveraged assets. With the futures market, this is a market that gives you access to a number of different things. If you are concerned about diversification and you think that's important, this is a market that provides the best diversification there is, because you can trade the stock markets, the Dow, the NASDAQ, the S&P 500, the Russell, some foreign markets. But you can also trade commodities. And one of them, if you listen to this show, you know what Josh's favorite one is.
Lean hogs.
It's lean hogs.
We haven't heard that before, have we?
We hear that every week, I think.
My memory, I forgot what I did yesterday. My bad.
Yeah, but it has something to do with lean hogs, I'm pretty sure. But you can also trade grains, corn. You can trade sugar. You can trade oil, gold, silver, the precious metals, currencies, interest rates. And not all of those things are correlated to each other. And by that, I mean, when one goes up, it doesn't mean that they're all going to go up. Or when one goes down, they all go down. There are some, for example, in the stock market. If the stock markets are going up, then maybe gold is going down. So there's an inverse relationship there. If you see one moving one direction, it may help you to determine how to invest in one of the other assets there. Futures trade almost 24 hours a day, which gives you a lot of choices there, a lot of versatility as to when you do it. The foreign exchange market, commonly called the Forex market, 50 to 1 leverage. That's fantastic. That allows a lot of people to participate in a global market with a smaller amount of money up front. It's sort of like I said, like a down payment. The leverage really lowers the financial barrier to entry for a lot of people. Forex is open 24 hours a day, and that's where you're looking at the difference in exchange rates between two different currencies. The other leveraged asset that is used by a lot of people is options, and options can be used. By the way, options, Forex, and futures can be used in upward moving markets and downward moving markets. And options can be used even if the market is just moving sideways. If it's just going in between high and low points, or if it's just flat, you can use options to your benefit.
Well, that's key, is to have the right asset for what you're looking to do. What is in your plan. And if you work during the day, these markets that Al's talking about, the futures and the Forex market, they're open in the evening. So you can participate at night. That way you're not stuck to that 6.5 hours during the day with the stock market. The stock market's a great place to be, but it's not the best for people that work during the day. So you have other opportunities that are out there to learn more about the futures market, the Forex market. So coming up next, I want to get into retirement. It's a topic that we always talk about. Everybody's striving for that day, and they want it to be yesterday. So let's talk more about what the smart money is doing a little bit different in retirement accounts. They're selling people funds, but doing something different in the public accounts. This is Josh and Al. We will be right back.